Chris buys a rental property. Daniel invests the same money into the stock market. Same starting point, same income, same timeline. They both believe they made the smarter move. One of them is wrong, but not for the reason most people think. Because one of them underestimated how expensive time can be, and the other underestimated how powerful compounding really is. And when you actually stretch this decision over 20 years, the outcome is a lot less obvious than people expect. Let's keep this fair. Chris and Daniel both have $58,000 saved. They each earn about $63,000 a year. Same age, same city, same financial situation. The only difference is what they decide to do with that money. Chris uses his savings as a down payment on a $290,000 rental property, a simple 3-bedroom home in a stable neighborhood. He takes out a 30-year mortgage at around 6.7% interest, which puts his monthly payment at roughly $1,520. He finds a tenant willing to pay $2,050 a month in rent. On paper, that leaves him with about $500 in monthly cash flow before any real-world costs show up. At this point, Chris feels like he made the right move. Daniel takes the same $58,000 and invests it into a total market index fund. No leverage, no tenants, no physical asset. He sets up an automatic contribution of $320 a month and doesn't think about it again. When people ask him what he's doing with his money, he just says index funds, and the conversation usually ends there. There's nothing impressive about it. On day one, Chris has something tangible. A property, a tenant, something he can point to. Daniel has a brokerage account and a number on a screen. It doesn't even feel close, but how something feels and how it performs are two completely different things. For the first couple of years, Chris is living what most people imagine real estate to be. Rent comes in consistently. The property looks stable. He drives by it occasionally and feels a sense of ownership. He's building equity with every payment, and the property value slowly increases. Everything about it feels solid. Daniel logs into his account every few months. Some days the number is higher, some days it's lower. There's no excitement, no physical proof, no story to tell. It feels like nothing is happening. By year 3, the numbers start to tell a more complete story. Chris has collected a significant amount in rent, but once you subtract mortgage payments, property taxes, insurance, maintenance, and a few unexpected repairs, the actual cash flow is much smaller than it looked at the beginning. A $1,500 repair here, a $3,000 issue there, and 1 month without a tenant starts to change the math. After everything, his real profit is far lower than the clean numbers he first calculated, and none of that includes the time he spent managing it. Daniel, on the other hand, has invested his initial $58,000 along with his monthly contributions. With an average return over time, his portfolio has grown to around $80,000. He hasn't taken any calls, fixed anything, or dealt with any surprises. The growth is steady, but still doesn't feel dramatic. Chris still has one major advantage: leverage. His property has appreciated, and part of his loan has been paid down. His equity has increased, and that's real wealth built using borrowed money. This is the part that makes real estate powerful, but there's a side to that power that doesn't get talked about as often. Every dollar of rent has costs attached to it: vacancy, maintenance, repairs, insurance, taxes, and time. These don't show up in the simple cash flow number, but they show up eventually. By year 5, Chris understands this better than anyone. He's dealt with multiple tenants, unexpected repairs, and rising costs. His returns are still positive, but they're more modest than he originally expected. What looked like a high-return investment has settled into something more realistic. Daniel is still doing the same thing he started with, investing consistently and waiting, but now something changes. compounding begins to accelerate. The gains start generating their own gains, and the growth curve becomes more noticeable. By year 10, they're surprisingly close. Chris has built significant equity in his property, while Daniel's portfolio has grown to a similar range through consistent investing. From a net worth perspective, the gap isn't dramatic, but the experience is completely different. Chris has spent years managing his investment, dealing with uncertainty, making decisions, and staying involved. Daniel has spent almost no time at all. By year 20, both of them have built meaningful wealth. Chris owns a property worth somewhere between $480,000 and $520,000, depending on appreciation. His mortgage is largely paid down, and his equity represents the majority of that value. Daniel's portfolio, built through steady contributions and long-term growth, has reached a similar range. They arrive at nearly the same place, but they didn't take the same path. Chris traded time, attention, and responsibility for his returns. Daniel traded patience and consistency. Neither approach is wrong, but they are not the same, because the real difference isn't just how much money you end up with. It's what it costs you to get there. Time, effort, stress, flexibility. These don't show up in a spreadsheet, but they matter just as much as the final number. So when people argue about whether real estate is better than stocks, they're usually only looking at one side of the equation. The truth is, both can work. Both can build wealth, but only if you understand what you're actually signing up for. Because the answer that includes everything is the only one that matters.